Well, a major breakthrough for U.S. listed Chinese companies this morning. U.S. and Chinese securities regulators reaching a deal to grant the U.S. access to audits of Chinese firms listed on American exchanges. This comes as roughly 200 Chinese companies face the threat of delisting. Let's bring in Brendan Ahern. He is CIO of KraneShares. Brendan, it's good to have you on this morning. Certainly, this has been a long time coming. I know you've been following it over the years. It does come down to compliance, though, at the end of the day. How significant is this first initial step?
Certainly, the agreement is a major catalyst. It's a major first step to SEC Chairman Gary Gensler's statement on the issue. The proof is in the pudding. So in mid-September, you'll have the PCAOB, the Public Company Accounting Oversight Board, visit Hong Kong to start the process of auditing U.S. listed Chinese companies' auditors. And that's when the kind of rubber hits the proverbial road.
So it's important to note, sort of the backdrop to all this, which is the Holding Foreign Companies Accountable Act. I mean, as a result of that passing, the clock has started to tick on roughly 200 companies. Gary Gensler saying that inspections will begin on the ground in mid-September. What's the expectation here? I mean, for long, there's been a lot of China watchers who've said, look, the Chinese regulators will allow the opening of these books for the smaller companies, but not necessarily the big tech names.
Yeah, I mean, certainly our thesis, which has kind of played out, has been that the state-owned enterprises, that there's a small number of the almost more than 200 U.S. listed Chinese companies. There's a very small number of state-owned enterprises amongst those companies. And if you think about an audit review, you're looking at what are the inputs and the outputs to the net income statement, the balance sheet. And for a state-owned enterprise, there might be sensitive information that you don't want to hand over to a U.S. government agency. At the same time, the private companies, really a lot of the tech companies, there's nothing within those audit reviews that the information isn't as granular as knowing to say who's using Tencent's WeChat or who's buying on Alibaba's e-commerce platform. So I think the private companies, there's no issue. That's where the vast majority of the market cap is held. And certainly the voluntary delisting of 5 state-owned enterprises 2 weeks ago, that announcement was actually a strong signal for a potential deal that we saw come to fruition today.
What do you think the agreement today says about how the Chinese government is viewing this particular issue? I mean, for long, the expectation was that a lot of these companies would delist from the U.S. because they wouldn't be able to meet these requirements from the PCAOB. Not sure if they'll all meet it yet, but the fact is regulators did come to the table on it. What does that tell you?
Well, I mean, these companies, the vast majority of the 200 plus names listed, particularly the large cap companies, the mid cap companies, are audited by the China arms of the big 4 U.S. accounting firms. So the audit quality is not the question. It's simply the verification, the good work that the PCAOB does in verifying that work. So I think it's been more of an issue around the sensitivity of some of the information. The removal of the SOEs removes that obstacle. And I think, quite candidly, I think for the vast majority of these companies, being able to adhere to this global standard, the great work of the PCAOB should not be a big deal.
So, Brendan, we've already seen a number of companies seek out secondary listings in Hong Kong. You have those like Alibaba who are now seeking out a primary listing. I mean, this was all seen as kind of a, sort of a safer play in case of delisting in the U.S. Does the agreement today change that at all?
Alibaba, relisted in Hong Kong well in advance. That was back in November of 2019. They relisted, over 13 months before HFCAA was signed into law. So I think why the companies have migrated back to Hong Kong is it opens up stock ownership to Asian investors. Additionally, by migrating your primary listing to Hong Kong, it provides the companies an opportunity to be added to Southbound Stock Connect. So Southbound Stock Connect is a trading venue that allows investors in China to buy Hong Kong listed stocks. And by making Hong Kong your primary listing, it opens that up for these mainland investors. That's one of the qualifications. So I think ultimately the Hong Kong listing, along with the U.S. listing, allows the companies to increase their market capitalization, allows them to have their cake and eat it too, as well as, yes, it certainly provides a little bit of a hedge to potential the HFCA delisting risk. But I think it's more of a net positive for the companies. They can be in the U.S., largest capital market in the world, but also be listed in their own backyard. In the case of an Alibaba, 1 billion of their customers should be able to buy their stock potentially even by the end of this year, maybe first quarter of next year at the latest.
And Brenton, I know you've long been pretty bullish on especially some of these Chinese companies based on their fundamentals. I realize this is more about the future of, where they're actually going to be listed, but does this change your base case at all around these companies? I mean, has at least one geopolitical risk, if you want to call it geopolitical, has that been lifted, or is it too early to say?
Well, I think the major overhang really over the last two years, call it, almost 2 years, has been, you had the China's internet regulation, their anti-monopoly, antitrust movement. That argument is largely that's behind us. And then you had the HFCAA, which, if you put yourselves in the shoes of an active emerging market portfolio manager, you're very worried about buying some of these U.S. listed China ADRs because you're just worried about a new HFCAA news to come out, and that would make you look bad. And so I think today's news allows the 2% underweight to China relative to MSCI emerging markets for that underweight to get rectified, that we should see a revaluation of these securities that we hold within KWEB, our China Internet ETF. They're at half the PE, half of the PEG ratio relative to U.S. internet companies. We should see a bit of a re-rating there, which should be good for the names.
Brenton Ahern, always good to have you on the show. KraneShares Chief Investment Officer. Appreciate your time.